Alright, so this is Conceptual Framework Chapter 4, and it's going to be the most important topic in your life because you'll be doing this in your whole life in accounting. Now, why am I excited? I'm actually not excited. I have to pretend to be excited because this topic over here can get a bit tricky, and for it to get inside your brains, it needs to be more exciting, right? Okay, so conceptual framework. Now, conceptual framework, what do you do in conceptual framework? So, conceptual framework is basically rules that accountants have to, they have to know because these rules, every single business needs to apply to their financial statements, right? Now, there's like GAAP, there's all these things over here, characteristics, but we're going to go each and one of this whole PowerPoint and like cover everything on this PowerPoint, right? So, let's continue. Now, the link with chapter 3. So basically, this is like journal entries, right? So like conceptual framework basically links with journal entries because at the end of the day, you need to know whether that's an asset for you to put something as an asset when you're like recording an entry. For example, debit vehicles credit bank. You're debiting of vehicles, you're adding that vehicles to your assets because you know that vehicle is going to be an asset. But don't worry, we're gonna dive into this whole thing about what you can call an asset and so on. Now, there's lots of ways in which assets or liabilities recognized and like basically how they put into financial statements or whether they needed to be put in financial statements. Some people might put something that seems like an asset in the financial statements, but that's not the case. Sometimes it's not an asset. So this whole conceptual framework will tell you that listen here, this is a criteria of an asset. Whenever you get this is an asset. Whenever you get this is a liability. Whenever you get this is an income. Wherever you get this is an expense. So I'm going to tell you that right now. Okay, so GAAP. Now, GAAP means generally accepted accounting practices, right? It'll tell you, like what's all the rules, all the regulations, all these IAS rules, everything is in GAAP. This is for all financial statements in the world. They have to follow this set of rules. So let's continue. The conceptual framework is the objective of general purposes of financial reporting and concepts that underline preparation and presentation of financial information or financial reports. Financial reports are financial statements, right? So P and P, preparation and presentation. So to prepare a financial statement, you need to know what goes in the financial statement, right? That's how we get our conceptual framework of what is an asset, what is a liability. So we put it in there, right? Um, Presentation, you have to present it in a certain way. The financial statement, like it can't be all like dismantled or like untidy. It has to be neat. It has to be in certain accounts. It needs to be good. So now let's see. So we're going to cover all these one, two, three, four characteristics of a conceptual framework. No, not characteristics, categories or topics under conceptual framework. So what is the objective of financial reporting? In other words, why do we do financial reporting? So there's a business and we conduct financial reporting. Financial reporting. So you know how you get your report at school? Same thing. So with a business, that report of business is called a financial report. It'll tell you how well it did in its sales, how well it did in its liability. Basically, it includes all like the financial statements, everything related to the business, right? So normally, financial statements, right? They will probably benefit users. Now, what are users of financial statements? Users of financial statement can be creditors. That means people who you want a loan from. It can be shareholders, or it can be people that just want to see investors, right? Investors are people who want to buy shares in your company. They need to know how good your company is. So by giving them your financial statement, your financial reports, they can see that listen, this business is making R1 million worth of sale. This business is making a profit. So let's invest in this business, right? Now, what is stewardship? Stewardship is basically means supervising. So financial reporting helps determine the stewardship of the business, the supervision of the business, how well a business is doing. Okay, because a business has to supervise things. Like a business has to supervise its expenses. If it can't control its expenses, then it's gonna make a loss. So, stewardship is like leadership, but more of like controlling that everything is going good, right? Yeah, taking care of something. So anything that goes good, it's stewardship. So decisions depend on returns. Okay, so basically this is all for the users, right? The users of the financial statements that use want to know the equity, want to know the debt, want to know all this stuff over here, right? Um, objectives also, they want to know the resources, what assets the business has, claim against entity. So if it has loans, the bank will like claim some portion of the assets of this business. How efficiently resources are used. Are they using good resources? Not. So all those stuff, right? Now the best use, or the primary, the most important users that will use financial statements are investors and potential lenders, like your bank. Creditors are saying your bank. Okay, going concern. What is a going concern? Going concern basically means that the business will go into a future, will operate in the future. If you're a business and next year you know you're going to close down, you're not a going concern, right? So, going concern, the key word over here is going. You can go into the future. You can operate, not a going concern. You're not going in the future. You're going to close down. So that's basically what this whole thing says, right? Now, if what if you're not a going concern? Does it affect you? Yes. If you're not a going concern, you'll prepare your financial statements a bit different, right? So your value of your assets will be different. Your whole layout of financial statement will be different. But most businesses are a going concern because they're going to operate in the future. So we're going to do it like a normal financial statement, right? But just know when you're not a going concern, can't operate in the future, financial statements have to be different. So yeah, so going concern, financial statements are normally prepared under the assumption that the reporting entity, which is a business, is a going concern and will continue to operate in the future, right? Yeah, so there's no intention of liquidation. Liquidation is when a business closes down or business goes into debt and like he needs to sell all his assets, right? Okay, this is extremely important because they can ask you a question just based on this, right? So there's qualitative characteristics of useful information, right? There's two categories: fundamental qualitative characteristics and enhancing. I'll tell you how it's tested in exams. They'll tell you name and explain the fundamental characteristics. They'll just say that. You have to give these things here, right? They'll tell you name and explain the enhancing characteristics. They'll put this name enhancing characteristics and you have to put this. That's how they ask you in the exam, right? If they ask you name the qualitative characteristics and explain, you put this, you explain. You put this and you explain. So you see how it's structured. Now they might ask you to identify something, right? So in a case study, if you see it a scenario and you know for a fact, let's example in the scenario you're talking about relevance. You won't put relevance as your answer. You'll actually put no wait, you do put relevance. What I mean by if it's something over here, like example, you know in the scenario they say example, the business owner is preparing the financial statements, right? That will be neutral because it's biased. But you won't say neutral in your um, question, right? To identify on the case study, you'll say faithful representation because these are the like the actual stuff, right? Where is that? Yeah, these are the actual stuff. So you'll put that in your case study from the case study and so on. So what is relevance? Relevance means that the financial statement, everything in there must affect the users. You know, like it's important stuff. You have to put stuff that is very very good. Now in the next slide you'll actually explain relevance, so I'm not going to explain it. You're actually going to explain everything. So while I'm doing this, you can explain everything in the next slide. So yeah, so fundamental qualitative characteristics basically makes in financial information. There's fundamental. Okay, so fundamental, remember we're talking about over here these two stuff here, relevance and faithful representation. So what does this mean, faithful representation and relevance? So first we're doing relevance. Relevance means you including those stuff in a financial statement that will help the users to make decisions. So if you leave it out, it'll be bad, right? Decision makers can't make business. For example, imagine going to the bank and you want a loan, but in your financial statement you don't have your sales figure. That's a problem, right? So relevance says, listen here, you have to put your sales figure because it's going to influence the decision making of the user, which in this case is the bank. Now, relevance. Also, the stuff in the financial statement needs to be predictive value and confirmatory value. Now, I might be asking, what is that? Predictive value. Predictive future. So it tells you what your future could be like, your future inflows. So it predicts that, like, okay, so if you're a business now making a very high profit, in the future you'll probably be very profitable, have a lot of profit, right? Confirmatory value, it looks at the past. So it looks in the past how you did stuff. For example, on the financial statement, you made a sale of 1 million. You know, for the whole year in the past, you were doing good. You see, this future, this past. Materiality is very important. Materiality is basically things that you see in the financial statements. Whatever is immaterial means do not make a difference, cannot be in the financial statements. Example, you got, let's say, okay, so let's say in a year, right? I know this is doesn't make sense, but let it be so you can understand the situation. We bought stationery for 5 rand. If we bought stationery for 5 rand, will we put this in our financial statements for the year ending whatever year? Will our financial statement just have an account stationery and we put 5 rand? Yes or no? No, absolutely not. It's immaterial. What is immaterial? Immaterial means that it doesn't have the power to be in your financial statements. It's it won't affect the user. If I put that stationery in that financial statement, or if I don't put the stationery, will it affect the decision maker, the user of the financial statement? No. The bank won't care about that 5 rand, because in a business you're working with millions. Will you actually care about 5 rand? No. It takes money to make financial statements. It takes time. If you're going to add all those stupid, useless stuff in your financial statements that are immaterial, you are wasting time, resources. They're not going to affect the user. So you only include stuff that is material, which is materiality. So if info is material, it means that if leaving it out, it'll affect the user's decisions. That's materiality. Faithful representation. Now, whenever I think of faithful representation, you just have to know these 3 things. Because if I ask you to explain what's faithful representation, you have to explain each of the 3 things. Easily can be a 6-mark question. Explain faithful representation. 2 marks, 2 marks, 2 marks. Done. Right. Complete. Complete means the financial statement has to be all completed, right? It has to include everything. From last year to this year, everything has to include. Neutral. It must be done by a person not affiliated with the business. Or it mustn't be done by a person who you know is going to lie and be biased. Example, the owner. The owner is making financial statements that could be biased. So it can't be that. It must be neutral. Free from error. Now, you might argue with me that, listen here, no, nothing in life you can do 100% accurate. But this thing is saying free from error. It means don't deliberately make mistakes. Don't purposely make mistakes. You can make mistakes, but you mustn't deliberately make them, right? So remember, these 3 things have to be in faithful imitation. Now, prudence. What is prudence? Prudence basically says don't put more than what you should. Don't put less than what you should. That's basically what it means. So it's saying in your assets, don't make it higher. Also, in your income, don't make it higher than what it should. Because that's good. Like, if we have to lie, we'll put the assets more. Because that's good. That's value. You got so much assets. If you put your income more, that's good. That means you have so much income. So overstating your assets and income means putting more than what it actually is good. But that's bad, right? Because you're lying. Also, don't underestimate your expenses and liabilities. Because if you're underestimating it, you're putting lower than what it is. So if I owe a person 1 million rand, but if I say I only owe him 100 rand, that's like good in our way. But like that's lying. Also expenses. If I paid 100,000 rand for something, if I only financial statement put 20 rand, that's bad. Right? That's lying. So you see, so you can't do that. So that's faithful representation. Enhancing characteristics. 1, 2, 3, 4. There's 4 enhancing characteristics. Comparability. It has to be comparability on all your financial statement in your business of the previous year. So you're a business, you make a financial statement for 2020, 2021, 2022, each year. Each of those years, your financial statement should be the same account so you can compare. Put one account on the right, put another financial statement on the left. The right and left financial statements, you can compare. Verifiability. What verifiability? If you have a financial statement and if you look at a figure or if you look at an account, there must be information in the business that backs up that that is true. Example, I have in my financial statement bank amount 100,000. I need to look at the 100,000 and see if it's real. So I'll verify that. I will go to the bank, I'll get a bank statement, and it'll tell me, yes, I do have 100,000. That's verifiability. Everything in your financial statements must be verifiable. Right? Understand? Timelessness. Financial statements need to be prepared at the end of each year, as soon as possible. So, present your financial statements, timelessness. Present it early, soon as your year ends, present it. Don't wait. To understandability, it must be neat. Don't make your financial statement complicated. Make it neat so all people, even those who are not accountants, can understand those things. Elements. So your elements in your financial statements are 2, 3, 4, 5. I think it's sweet. Assets, liabilities, equity, income, expenses. That's 5. So these are all your elements, right? Okay, this is extremely important. I can tell you right now, this is going to be a question or test 2-1. They'll give you a case study and they'll tell you this whole case study, and in there they'll say recognize how you'll treat this with the criteria and all. It's probably going to be an asset, by the way. Probably. 90% of the time they make you recognize an asset instead of a liability, because liability is very easy. You can't give lot marks. They'll make you recognize an asset, because an asset you can have an 8-mark question over there. So asset definition. An asset is a present economic resource controlled by a business as a result of past events. It has a right to the potential to produce economic benefits. Memorize everything I just said right there, because that's a true definition. You get an exam, write that. Now, what does it mean, an economic resource? It means it's something in the business that can make money. It has a right to make money. I have, let's say, a vehicle in the business. I can sell it, I can make money. But also, the reason you want to say economic resource, it doesn't have to be physical like money. You can say, like, you can use your car to transport goods. That is an economic resource, doesn't have to be money. Assets definition. So, what does it mean when I say it has the right to the potential to produce economic benefits? It means it can use that asset. So it can use like a vehicle, it can use the asset, it can receive cash. For example, your inventory, your trading stock, your products, you can receive cash for it if you sell it. All those things. That's what I mean by right to potential. Everybody has a right to potential in life, by the way, just to know. Anyway, not the point. If the right doesn't, okay, so what this means, if the right does not create it's not an asset. For you to have an asset, recognize an asset, it must have an exclusive right. An exclusive right means you own that. You only have rights to it. You own that. You can't call something an asset if it doesn't have an exclusive right to it. For example, if two people own an asset, the bank and you, that's not an exclusive right. So you only have to own this particular thing to be called an asset. Let's see. Okay, what's wrong here? 1 second, having some technical difficulties. Okay, if this thing can work. Okay, so we just have to bear with this. Okay, so assets definition. So I already told you the assets definition, right? I already told you that. Memorize that thing. Control. Now, what does it mean the business has control? It means the business can literally control that asset, right? If you have a vehicle in the business, you can use it whenever you want. You can sell it whenever you want. Nobody can tell you anything because you own that. That's an asset, right? So that's an asset. Liabilities. Now we're going on to liabilities. A liability is a present obligation of the business to transfer an economic risk as a result of past events. It's a present obligation. Okay, so memorize what I'm going to say now. This is actually the full full definition. A liability is a present obligation of the business to transfer an economic resource as a result of past events. The obligation is the duty or responsibility that the business has and has no practical ability to avoid. If it does avoid this particular thing, they will suffer economic consequences. That's the true definition of liability. Definition, that's liability. Why something's not working, yeah, man? Come on, not now. Yeah. So present obligation means now what it means. For something to be an obligation, it means something that happened in the past. So present obligation means that you benefit from it. So if you benefited from something, for example, you get a loan from the bank, 100,000. Once you get the 100,000 and you use it, you have to repay the bank back. That's an obligation. So you receive benefit from it. So anytime they may ask for a liability question and they put a case study, say that you have received benefit for that product. So that is why it becomes a liability. With your definition, everything. Don't forget that. Also, if any actions to avoid the transfer of this resource that would have a negative economic consequence significantly worse than the transfer itself. I told you this in my definition, right? But you must explain this, right? Equity. Equity is the easiest, right? Equity is a residual interest of the assets of the entity after reducing its liabilities. What a formula for equity is assets minus liabilities. E is equal to A minus L. To get that is easy. Asset equal to owner's equity plus liabilities. You isolate equity, that's what you get, right? Definition. So an equity is a residual interest. What is a residual interest, you might ask? It's what the owner owns. It's what the owner is left with. The worth of the business, the net asset value of the business after it deducts its liabilities from the assets. That's basically what equity is. Um, yeah. So the owner's claim of the business it refers to equity, right? That makes complete sense. Equity. Okay, transaction that leads to a change in equity can be with the owner and cannot be with the owner. Now, don't get confused. Income and expenses are not the owner, but equity there's an exception. It can be with the owner. You might ask why. Think about drawings. Drawing goes under equity. Income. Definition: increase in assets or decrease in liabilities other than those from the owner, right? Expenses: decrease in assets, increase in liabilities other than those of the owner, right? That's very easy. Now, the very important 8 mark question, easy. This is coming out. This 8 mark question over here, probably going to be in the exam. Every time they ask this, no matter what, every conceptual framework paper they're going to give this recognition criteria. Now, you might see this and be like, oh, I'm dying. Simple. I'm telling you these 3 points. Memorize the 3 points. You write maybe like 3 lines each on those 3 points. 9 sentences. You're getting those marks. 8 marks, whatever. Right. So, recognition. Now, always in the exam, you're going to get your case study, right? You're going to get that case study. It's going to discuss about a business, owning a product, owning bicycles, owning whatever, and they'll say based on the conceptual framework, the recognition, the definition, soon as you see that, smile because you're getting full marks, right? Based on the conceptual framework, the recognition, the definition, how will you recognize this thing? And they'll basically say, like, basically you first have to identify what's it, right? Okay, so you might ask me what's these 3 points I'm talking about. Whenever you get to the 8 mark question, right, you discuss these 3 points. Number one, the definition of that element. So what I mean by that, if you know what's in the case study, if that's an asset, you put the whole definition of an asset. So you know how in my previous slide I told you memorize this definition of the asset. You just have to put that. Number two, produces economic benefit. You must talk about how this thing they talk in the case study can produce money, can produce economic benefit, right? That was number two. Number three, it must you can it can be reliably measured. So what that means, you have to say like how this thing in the case study, for example, a bicycle, you can put a cost to it. So for example, if you bought it for 100,000, you can say in your finance statement that is worth 100,000. If something you can't, if you can't put a price to something that's not an asset, you can't put a price to something that's not an asset. I repeat. So obviously, whatever you buy the thing for, that will be a price to it. That will be the measurable thing. So you already discussed that. So 3 things to discuss: definition, what economic benefit it provides, and number three, it must be reliably measured. If those 3 conditions are met, it's an asset. You have met the definition recognition criteria. Also, I forgot to say recognition. What does it actually mean? It means you can put those things in your financial statement. So if an asset like a car you got bought, if it meets all these three things I said, the recognition, it means you can recognize it in your financial statements. You see? So memorize that, right? So I explained all this. So the low probability of income. So economic benefit, I told you, it must produce economic benefits, future economic benefits. Um, so I told you this must produce future economic benefits. So obviously, if you do not, if it's wait, where's the thing? If it's not going to produce economic benefits, if there's a low probability of inflows or outflows, that means if there's a low economic benefit, then you don't recognize it, right? But if you know for sure there's a future economic benefit, then you recognize it, right? For example, low economic benefit. How can I describe this? If you are getting a bike today, but you bought it from a scammer, do you think you're gonna get it? No, right? So that is what I mean. You're probably not gonna get it. So like, why are you recognizing it as an asset? But you can't recognize it as an asset, to be honest, because you don't have control of the vehicle yet. But you get what I'm saying, right? Example: you purchase a delivery vehicle for 510,000 rand. Would this business recognize the vehicle as an asset? Right. Let's check it out. This vehicle. So you see. So the definition can guide you on what to say. So the definition is it's a present economic resource. You should put a number one on top. You can discuss that, yeah. The business has the right to sell or use the vehicle. And then in your definition, you have potential to generate economic benefits. Then you just say this, that a business can use the vehicle directly to deliver or it can be sold. Then I said it's a business that has control over this economic resource. That's in the definition. So you can also discuss it over here. The business will obtain economic benefits. And then I said as a result of past events in the definition. And in here you can say this over here. So you see how just by the definition you can put your 1, 2, 3, 4 numbers on those points, and so like memorize this. I'm telling you. Present economic resource, you can put a point. Potential to receive economic benefits, put a point. Control, put a point. Past event, put a point. All those 4 points are in the definition. That's your keywords in the definition. Memorize the definition. Memorize this. 8 marks is yours. Recognition and measurement. Yeah, so recognition, I told you, is incorporating the item that meets the definition of recognition criteria. I told you that in the financial statements. Now, going on to measurement. What is measurement? So you know how in the financial statements you got assets over there, assets, and you got an amount. That's measurement. You're basically saying, okay, there are those elements in or things in your financial statements. How is the amount there? That's measurement, right? It's determining the money amount at which elements of financial statements are recognized and carried at, right? Also known as carrying value, right? So, what is this, right? So, I'm going to put an example out there to make you easily understand this, right? You bought a vehicle. So, initial recognition means that you look if it's an asset. So, you go to the whole recognition. Will it provide economic benefits? Can it be reliably measured? And it means the whole definition. It's an economic resource that I use in a business control, all that blah blah. Then you put in your financial statements. That's initial recognition. Initial measurement, it's what you will recognize it at the cost price. So if you bought it for 100,000, you put it under your assets in your balance sheet as 100,000. So you record the cost of that. What is subsequent measurement? Do you think the cost of 100,000 will be the same? No, right? You got depreciation. You have to change it. So changing this original amount is called subsequent measurement, right? But remember, we not. This is about cost, right? We'll just now learn about the two methods here. But yeah, derecognition. Not all assets in your business will last. If you bought a vehicle now, sooner or later you have to sell that vehicle because it's not going to work, or you're going to get rid of it because it's broken. That's what derecognition means. So you're taking that asset out, you're taking that vehicle out from your balance sheet, your financial statement that no longer works, that you're selling off. You're taking what was in your financial statement out. That's derecognition. So you see how it links? Over here the vehicle goes in, over here the vehicle goes out. Your financial statement. Let's see. Derecognition is defined as a removal of a previously recognized asset or liability from a business financial position. That's exactly what the definition, right? So know what's that definition, yeah. measurement. So there's different ways in which assets in your business can be measured at, right? I will tell you the most two important ones. I don't see any other tested over here. Historical cost and fair value is the most tested ones, huh? Historical cost is very, now listen carefully what I'm trying to say. Don't get confused between carrying value and depreciation. We're not dealing with this over here. We're dealing about the cost price. So you know how if you picture your financial statement to represent an asset, you have cost and then below it you have accumulated depreciation. We're talking about the cost account only. The cost account, no depreciation. We're talking about the cost account. The cost. So the ways it could be measured, the cost of this only, is historical cost. So example, you bought a car for 100,000 rand. Every single year, no matter what, if you look at the cost on the finance statement of this vehicle, it'll be 100,000. That's cost. But fair value, what it means, you record it at what it's worth in those years. I bought a car for 100,000 last year. This year, if that car now is worth in the market 150,000, I will go to my cost in my balance sheet account, my cost, what my vehicle costs, and I'll adjust it so it reflects 150,000. So I'll add 50,000 over there to reflect it. So you see, two different methods. Historical cost remains the same. Fair value, it changes, right? If it's worth more, you'll add more to the cost. If it's worth less, you'll add less. That's actually called, what it's called again? Revaluation. Yes, revaluation, right? Now you'll actually understand these two methods better. So fair value, yeah, it's a price which you receive for an asset. So it's a market price, what it's going for. Now this is very important. When active exit future value is a market price. Okay, so we'll go back to that just now. Yeah, we'll go. So when measurement base is used, initial recognition. Okay, so which measurement base do you use? It's what best to suit that asset. For example, a vehicle, historical cost or fair value. Historical cost, why must you put it at fair value? You know fair value, what people are going to pay for that vehicle will decrease over time. So your vehicle is going down every time. That's stupid, right? But for example, a building, will you put it under historical cost? No, because buildings, or I mean, no, sorry, not land increases in value. If you're going to put it under historical cost, then it's going to remain that amount forever. But you know land in today's world is only going up or up, up. So put it as fair value. So it's worth more every single time. Time value of money. Now you might be thinking what this means. I also got stuck on this for an hour over here. But I researched it, and basically what it means is this, right? So 1 rand today could worth more in the next year. True or fact? I mean, true or false? True. So this 1 rand, right? You can put it into a fixed deposit, or you can earn interest on it, and I can get more money, right? So yeah, that's basically what it means, huh? So I'll tell you straight. This is not come here. Don't test you this thing here. But basically, it's simple. If if you put 100 rand in a deposit of 10%, work out what's 110% of that. You get that, right? Easy. And then you just work backwards. Um. So okay, time versus fair value present given an asset when you pay for cash on the. Okay, so what happens if you purchase something on cash? I mean, what happens if you purchase a vehicle but you're only going to pay for it 1 year later? What will be the amount you put in a financial statement? It will be the present value amount. I might be thinking, what is this? What is this? What is this? Easy. Present value amount is very, very easy. Very, very easy. So, okay, so I can't draw on this right now. Wait, I can, but no, I can't. Okay, I can't, but just take note of this formula. Okay, so PV, which is present value, is equals to future value over open brackets 1 plus the interest rate close brackets to the power of n. What is this? Future value on top is the future value, what it's worth in the future, over open brackets 1 plus the interest rate is like example 10%, 20%, 15%. You'll put that, right? Like close brackets and then to the power of n, how many years? N stands for years, right? That's a formula. Took a delivery vehicle and paid 100,000 via EFT. So remember, this is blocking it, right? But the following transactions occur on 1st of January 2021. Remember that, huh? Took a delivery vehicle and paid 100,000 via EFT, easy journal entries. Debit vehicles credit bank. Let me check. There we go. Debit vehicles credit bank 100,000, easy. Um, this one took a delivery of inventory. The business will pay on 31st March that amount. Okay, so see over here, this is taking place on 1st January. All these transactions. So on 1st January he took a delivery of vehicle. So 1st of January he took the vehicle, but he's only gonna pay 31st March. So that's trade payables that he owes. Then the payment period is less than a year. That means he's going to pay for the goods in the same year. So what transaction? It'll be debit inventory, credit trade payables. This is on the month that it was recorded. And then you're going to pay, this is when he pays back during the year. So debit trade payables, credit bank, right? So that's the amount. So why this thing is there? So now let's see. Okay, why? Okay, wait, let me just check. Okay, so took delivery of equipment. The business will pay 1 million rand on 1st January. The payment period is more than 1 year. Assume a fair interest at 12%. This is where that formula comes in handy. So the way this is done, right? It's simple. I want you to first calculate the present value of this. So you'll put so this is actually the FV, the future value amount. So present value is equals to future value. So you'll put 1 million over, I told you the formula, open brackets 1 plus 12%. You can put it as 12 over 100, close brackets to the power of 1 year, 1. Now you get an answer. So once you get the answer, it's perfect, right? So the business report on 1st Jan. Okay, so what is the journal entry here, you might ask? So if you look at it, here's it over here. Wait, that's not it. That is not it. Okay, so we are. So if you do this, my formula, what I showed you, you should get 892857, and you'll get some decimals. That's fine. Debit equipment, credit trade payables, because you're owing this money, right? You bought this equipment, but you're only going to pay in the future. That's one journal entry. Now, the next journal entry is paying this amount. So when you pay this amount, you'll do the opposite, say debit trade payables and credit bank with the same amount. Fine, perfect. Now, I might ask what this entry is. We're not taking out a loan, but listen here. For the sake of simplicity, whatever the amount you get minus the present value amount, you'll always put this no matter what. So, funny enough, this is actually like eco. So, you know how I get opportunity cost and all that? Where, like, it's not physically money like that, but it's like that. So, basically, that's like that. Technically, right? So, yeah. So don't think too much about it. It doesn't even come much, to be honest. But yeah, just know that how you work it out, right? Okay, so yeah, that's it. So going on now, let's see. Subsequent measurement. I told you, you measured something and the cost account. I'm keep on emphasizing the cost account. Don't look at the depreciation account, because then you're looking at carrying value. I'm not talking about carrying value over here. I'm talking about the cost of the vehicle. So when you're changing this, it's called subsequent measurement. Okay, so there's two ways which you can do measurement. Historical cost, fair value, right? Historical cost, the cost of the vehicle will remain the same throughout the year, every year. Fair value, it changes, right? Completely changes. The cost price change every year. Depends on what people pay for it. So, this came out last year. Very good. I mean, very important. So, measurement of PPE. So that is why I told you the two costs is most important is historical cost and fair value, because these are the two modules that what's it called? Two ways, policies we're learning here in accounting 102: cost model and revaluation. Now what this means? Cost model basically means you're going to use historical cost for your vehicles, for example. That's what it basically means. Revaluation model means that you're going to use the fair value method for your vehicles, for example, for the whole every year. So the costs now, how do you do this in a transaction? Okay, so a business purchased land for 400,000. The historical cost method and the fair value method, also known as the revaluation method, same thing, will do the same thing for this transaction. You bought the land, easy, debit, land, credit, bank. Right, easy. But this is where it gets a bit tricky. For the cost model, what I told you, no entry. Why? Cost model, if you bought the account, if you bought um the, let's see, the costs remain the same always, so no matter what it changes, it doesn't matter. Let me just go back here because it's not working. Okay, so business bought land for 400,000. In the cost account, land, the price will always be 400,000. That is why over here, although it went up by 50,000 more, so they don't actually say here, but basically, um, it went up by 50,000. What we're looking at, the land. So the land went up by 50,000. How do we record this? The cost model, there's no entry. Why? It remains the same cost no matter what. But the revaluation model, also known as a fair value model, you need to take account in it, right? Because if it went up by 50,000, we're using the fair value, so that way it's worth more than 50,000. So let's see a debit land 50,000, credit revaluation gain. If they ask you to do a closing entry, you do the opposite here. You debit revaluation gain and you credit revaluation surplus, right? So yeah, that's how you do it now. So let's memorize that, right? Cost model, no entry. Revaluation, there's an entry. Asset damage. Okay, so this is the talking about impairment, right? So let's say an asset got damaged. That reduced its value very, very low. You have to say goodbye to it. That's called impairment. PPE damage. You're doing an impairment test. I'll tell you about this now. A recoverable amount is basically like what you can get from that asset, basically the money amount. Value in use. Value in use is the present value, the same formula. So value in use is a present value thing. But like they don't test it, I know what I'm saying. But basically, the way you do this is easy. Okay, journal entries. So, do they actually give you an entry? They don't give you an entry over here. So like, how must I explain it? Okay, so how do you calculate the impairment amount? They don't give you the amount, so I'm gonna explain it to you. So let's say if the carrying value of your vehicle is 100,000, the carrying value. How to calculate carrying value? Cost minus accumulated depreciation. That's your carrying value. So if your vehicle carrying value is 100,000 rand, but now it's damaged, it's only worth 80,000 rand. You have to impair it. So that's my impairment test. My what is worth now is less than the carrying value. You do the impairment test. What is worth is less than carrying value. You do the impairment test. I repeat, you do the impairment test. That's what the impairment test is. That's what you know if you're recorded as an impairment. So to do this, you know it's 20,000 rand. So it has to go down by 20,000. So easy. Debit accumulates impairment. Debit impairment expense, credit accumulates impairment. So it's similar how depreciation works. Because depreciation, you say debit depreciation expense, credit accumulated depreciation. But instead of depreciation, you just say impairment, right? Easy. That's how you do it. So debit impairment expense, credit accumulated impairment. You have an accepted account for impairment. Don't put this under depreciation, right? Accrual basis income and expenses must be calculated in the same period, right? For example, somebody from, so let's say you're renting an office space. So the tenant says that, listen, I'm gonna give you rent for next year. So you know that's income received in advance. You won't record it under the income for this year, right? So that's accrued, right? So yeah, that's it. Yeah, it is a very long video I did, but it explained conceptual framework, what can be in test, and like just know this whole thing very, very well, because conceptual framework is very important, to be honest with you. But yeah, I'm out of breath in this video. Thanks for watching. Don't forget to like and subscribe. Yeah, just like, yeah.